Steve, what do you see as some of the bigger risks to the bond and equity markets given recent global events?
I think it's important to look at the backdrop of money. And money is the raw ingredient behind the marketplaces. And what we're starting to see is after years and years and years of incredibly loose money, quantitative easing, various ways that the Fed and other central banks have been throwing money at the markets, that is starting to change. The Fed is actively raising rates, and they're letting their balance sheet roll off. We haven't really started full quantitative tightening, but the Fed is definitely a headwind rather than a tailwind. Not necessarily a major headwind, but certainly if you're not outright fighting the Fed's certainly not giving you a push. The ECB is a little bit further behind the curve, which is why you still see interest rates in Germany in the negatives, good ways out the curve. But what happens in a situation like that is a lot of the easy money trades sort of run out of steam. And the first easy money trade that we saw run out of steam earlier this year was the short vol trade. Oh, it was very easy to short volatility. There were all kinds of products to let you do it. Volatility was never rearing its ugly head again. And then one day it did, and it did in a hurry, and it did in a heartbeat. And it was a very ugly outcome for some. Overall, the market sort of digested that, tested some lows, and has moved on since then. And you're actually seeing certain indices recover to all-time highs. The next one we saw has been roiling in certain emerging markets. And emerging markets, it's been known to say that like if the U.S. catches cold, emerging markets catch pneumonia. And you have seen some emerging markets in some real trouble with some currency crises, one of them being Turkey, one of them being Argentina. Again, this doesn't affect the vast majority of global investors because not everybody is invested in emerging markets. Not everybody's invested in emerging markets in a big way, certainly, except for dedicated investors. So for the most part, it's more of the backdrop. Italy, which is an emerged market, but sometimes doesn't always act that way, provided the latest bit of shock. And that was an interesting reminder to the bond markets, certainly. The equity markets definitely had a bit of a hiccup, which was quickly reversed. But there was some true ugliness in the bond arena. Let's examine that. The going feeling was among U.S. Treasuries that rates have to go higher. You've got inflationary pressures, oil's up. The tariffs could provide inflationary pressure or not, but that's sort of an open question. But certainly a strong economy and a Fed that's been raising would imply that the easy way to play the bond market would be from the short side. So a lot of people did crowd into that short trade. And guess what happened when Italy gave its little tremors? There was a flight to safety. And when there's a flight to safety, that's usually manifested through the U.S. Treasuries as perceived as sort of being the globally safe asset. Well, if you've got a big short position and a lot of money rushing into something where there's a lot of shorts, you're going to get short squeezes. And that's what you saw in the Treasury complex. So actually, it was very disruptive in the sense as Treasuries rally, there was a lot of money lost because there were a lot of speculative shorts on the sidelines. That seems to be playing itself out right now. The markets seem to have come to some grips with what's going on in Italy. They'll give this new government a chance, and we move on. And it was an interesting situation to try to explain to people. Why did the markets go down today? Why did the bond market react like that? Why did the dollar react like that? And, because Italy's having trouble forming a government. And people were saying Italy always has trouble forming a government. What's new this time? And I won't go into all the geopolitics of it, but basically, this is what starts to happen. There are little things that occur, little butterfly wings in various parts of the world that magnify themselves, whereas they would get swept under the rug in an easy money environment because there's just more money flowing in. That has an outsized effect in smaller, unusual places, and if you have enough of them, it does start to filter back. The two strongest dominoes are probably government bond markets because there's just such a natural bid in them. There's just such natural use for them, and the equity market. And the equity market particularly is probably the last domino to fall, if the dominoes were to fall, because right now you're buoyed so much by corporate buybacks. This is a phenomenon that we've seen, and in many ways it's been amplified by the recent tax legislation. So you're seeing companies buying back stock in a very big way. There's a bid under the market as a result of that. So while that's there, it's hard for the equity markets to sustain a big sell-off in a meaningful way without a catalyst. And when I say like the catalyst, you've got all these oddball catalysts coming from around the world. You need more of a meaningful domestic economy type of catalyst, and there's plenty that can come up on the horizon. And I'm not really going to get into them here because it's just would take us down a completely different path. But that's, I think, why the stock market has shown relative lack of volatility in recent weeks, despite some of these hiccups, and why I think investors are feeling somewhat sanguine about following the buybacks. But that's the thing to watch for. As you start to see more of these little weird oddball shocks, they're not all buying opportunities necessarily, and you have to start thinking in those terms. When money's flowing and the Fed is wind in your sails, yes, they're buying opportunities. When you don't have that backstop from some of the world's central banks, or you have political issues, that's when you have to start considering whether it's reflexively a buying opportunity or a time to reassess risk and reallocate portfolios. Don't see it right now as we sit here today taping. That can change tomorrow, it can change next week, it can change next month, or not at all. But again, remember, the central banks are not as friendly as they were, and that makes shocks more likely, and it makes it a little more treacherous to just jump right back in if you see a little bit of what you think is a buying opportunity.